that is the toughest act to follow in the lineup.
I can change it.
You can. No, I've had to rewrite my talk, and so I won't be leaving. What I would like to do, and my name is Jack Robinson, and I am the vice chairman and the portfolio manager with a firm in Boston called Trillium Asset Management. Trillium Asset Management, and I'm not here to sell Trillium Asset Management to you in any way, manages well over $2 billion in what's called ESG, based on ESG principles, which is environmental, social, and governance principles. I'm going to go about this in a little bit different way. I have 4 points I want to make. Bill's already made 2 of them, so I'm going to start out in a bit of a different way, if I might, which is a personal experience. In 1979, a man by the name of Lyman Wood, which may be a name many of you remember, he was then the president and CEO of a company called Gardenway, which was headquartered in Charlotte, had operations in Troy, New York, and marketing operations in Westport, Connecticut. Drove to Boston to visit with me and a partner of a money management firm called Trinity Asset Management. And he came to Boston to recruit me to be his CFO of Gardenway. And also to become the president of their nonprofit, which was then called Gardens for All, since changed its name to National Gardening Association, is still active in Vermont. And there have been a lot of offshoots from these 2 organizations. But in that process, and there's a lot of history that I won't get into, but in that process, I learned a couple of things that are important that I want to share with you. One, I learned about myself. I really didn't like being responsible for 1,400 employees. In those days, the head of HR reported to the chief financial officer, which I think is a mistake, and so that's since changed in many forward-looking companies. But the other thing I learned, which is pertinent to this discussion, more pertinent anyhow, is that as the CFO of Gardenway, I saw firsthand every month the numbers and what was our most profitable product, what was our least profitable product, and what the impact, the financial impact was of all the things we were doing as a company. Now, for those of you who don't know Gardenway or remember it, at that time, Gardenway was a $100 million operation. It was very profitable. Our most profitable product was taking used rototillers in exchange for new ones, which we would sell. We would refurbish the used rototillers and resell them. So sometimes that required no more than a coat of paint, or a new engine, or new tires, etc. That experience of being the CFO of Gardenway taught me that you could be socially and environmentally responsible and not have it adversely impact your profitability. We were, I believe, one of the early companies, if not the first company in Vermont, that provided childcare on site. And we did a lot of things for the community and donated a certain percentage of our profits to other organizations. So we were actively involved. So here I am, not liking managing a lot of people, and the thought occurred to me, well, why not incorporate green thinking into the investment process? Now, my background at that time had been working the floor of the New York Stock Exchange, and I was active in money management, working with many large institutions and states and municipal organizations. But having seen the numbers so clearly, I said, why not just incorporate green thinking into the investment process, in addition to doing fundamental analysis, in addition to doing technical analysis, in addition to applying a quantitative valuation screen to the process. So I started a firm here in Vermont called Winslow Management Company, incorporated in 1983. And I started doing that. And the first question I got from my first to clients was, well, how much do I have to sacrifice returns if you invest in a way that's consistent with your values and, by the way, with my values? And I said, I don't know. I don't think it's going to hurt. And if you stick with me for a while, we'll find out, but I don't think it will. So I went down that path, and for 7 years, worked with these clients, and basically did not invest in about 35 or 40% of the S&P 500. That would include all fossil fuel stocks, all tobacco stocks, all nuclear stocks, and all weapons. Now, after doing that over 7 years, I discovered you really didn't have to sacrifice return. I couldn't prove that you necessarily made more money, but I then decided that I'd go beyond what was called negative screening and get into positive screening, because in early 1990, a company named Whole Foods went public, and that was the poster child for green investing. But by the way, I trademarked the term green investing. That's how early on I was in that process. It doesn't always pay to be the first, but I learned that lesson too, but I've had a lot of fun doing it, and I've seen a lot of what you're thinking and talking about here in various iterations. Now from that, I started a mutual fund called the Winslow Green Growth Fund based on those principles, and we moved slowly from negative screening, we always have negative screening, and moved into positive screening, and over a period of 17 years was able to outperform the index after fees by 250 basis points. That's the equivalent of 2.5%. It's financial basis points. So I proved to the clients, and I proved to myself, because that was my big question, if you invest in a way that's consistent with your values, you don't have to sacrifice returns. You can indeed do better. Now, there are lots of people that will have different things. Just because you're green doesn't mean you're a good investment. I can assure you I've made plenty of those mistakes. But if you apply the basic fundamental techniques of fundamental analysis and all the other disciplines that are important to being an active money manager, you do better by incorporating. So I want you to understand. That's my background, and that's how I got involved in this. It basically started right here in Vermont, working with a company that applied these principles in a way that was consistent with its values and very, very profitably. Now, since then, we've learned a lot more, as Bill mentioned, about climate change. We've read, and I'm not going to talk about climate change, I promised you I wouldn't, but we now know that it is a serious, serious issue, and it's an issue that is probably the major issue, defining issue of our generations. I'm 73, and there's some younger people in the room, thank goodness. It's of all generations, and frankly of this century. It is a very, very big problem, and as he said earlier, it's getting worse, and all the data shows that. I mean, to just think that we just had the hottest 3 months in history, one hotter than the other, it's really scary. Now, so that gets into divesting, if we might. Now, I'm supposed to be the numbers guy here, so I did put together some numbers, and I'll get to those in a minute. I want to speak, so the point I want to make is, number one, is you don't have to sacrifice, in my opinion, returns to invest in a responsible way. I've proven that personally through negative screening. I've proven it in a positive way. And today, you can, through an index fund, and I don't know, Madam Treasurer, if you use index funds, but the cost of index funds are exceedingly low, and you can screen out very easily fossil fuel stocks. The cost of that is minimal if you're using index funds. So one of the people I advise, another state in New England, is using index fund and paying annually 1 basis point. 1 basis point, and for international, 3 basis points. Now, if you add on that a screen in State Street in Boston, or BlackRock in New York would be happy to provide you with the service at extremely low fees. You can do this and screen out fossil fuels, all of them. There aren't many coal stocks to screen out anymore because half of them are bankrupt, as you've just heard. Screen out excess. You will not, over a long period of time, have to sacrifice returns. I proved that to myself. I proved that before I was able to build a business and sold it very profitably, by the way, to a larger money management operation in Baltimore that wanted to get into the sustainability business. So that's the first point I want to make, and sorry to be so long-winded. I promise I won't be as long-winded as we move on from here. The second point I want to make is about engagement. And we at Trillium have 5 professionals that are fully engaged with companies on engagement. We do it every day. We do it as part of the service we provide. We do not engage with oil companies because they don't listen. They won't do it. They are unable, this is a big generalization, but they're unable to change their business model. What you're basically asking them is to change, to do a total pivot, not a partial pivot, but a 180-degree pivot, because their whole business model is based on what is in the ground and what they need to get out. And so, as the Rockefellers tried to engage with ExxonMobil unsuccessfully, and you would think that a company that was founded by their great-grandfather, and they are the largest individual shareholders, could make a difference, they got nowhere. It's not surprising to me that the Treasurer of Vermont didn't get anywhere with them either. Engagement works a lot of the time, but it doesn't work all the time, and it is not working in terms of the fossil fuel companies, I can assure you of that. It's not going to work. The 2 other points that I want to make, and I will get to the costs of not divesting are huge. And if you go back, and as I did, and looked at the notes from the Vermont Investment Group from 3 years ago this month, when divestment was discussed and was posted, and no decision was made, also 2 years ago and more recently, the cost that has been to the pension plans is huge. It's multiple millions. And somebody asked me at some point today, well, how was it that you were helpful to get, how did California get going down this path? Well, somebody published an article on how much it costs the state of California to stay in their fossil fuel stocks. It was a huge number. And after that got published, they moved forward and are continuing to move forward. So I would say that when you look at costs, you have to look at the total cost. You can't just look at, say, a trading cost or the cost of one consultant or another. It's the total cost. And if you look at how much has been lost in these fossil fuel stocks, the losses far outnumber the actual out-of-pocket costs that the fund would have to put up to go down this path. Again, if you're an index fund, it's very easy, just twist the dial, and you do it a little bit differently. That's the public. Now, it is more difficult with commingled funds for sure, particularly if it's in private equity. But I think what you've got on the table here is a very practical step in the right direction. It should not be costly. And from my point of view, having talked about fiduciary responsibility with lots of people over the years, I think you do have a fiduciary responsibility. How are you going to feel knowing what's coming as it actually comes? You had a chance to do this and you didn't do it. I would urge you to think it through and to make that decision. The last point I was going to talk about is the slippery slope, which apparently is something that's been talked about going down that path. I believe state of Vermont, like Massachusetts, the legislature passed a no tobacco for the holdings, and also the apartheid votes are similar to that. So from my point of view, there's precedent for this, but this is even such a bigger issue than those two that to me, it's almost compelling. Lots of the other considerations that might be brought up don't pale in comparison with this issue. This is a serious, serious problem. So for that, I'll stop my comments. Those are basically the 4 points I want to make, and I'll entertain questions. And also, from Madam Treasurer, if you have any.
Robbins, if I understand you correctly, you seem to be implying that at least our treasurer has breached a fiduciary responsibility to the state.
I'm sorry, I didn't understand. Hear your first part. Somebody has breached their fiduciary responsibility?
Listening to your testimony, I get the impression that you are implying that our treasurer has breached her fiduciary responsibilities to the state.
Absolutely not. I am not implying that. I am saying that I think it's excellent that you are seriously looking at this issue, as most institutions are, frankly, that have fiduciary responsibilities, and doing a lot of research. What I'm saying is that the opportunity to make this change is here. It's been here before, and as you've continued to explore it in different ways, I'm suggesting that the cost of doing that is not as big as the cost of not doing it.
Let me ask the question going forward into the future. Should the state not follow the path that you are suggesting, would you then be saying that the state was having its fiduciary responsibility researched in any way?
I'm not a lawyer. I do think that a lawyer would have fun arguing that position. Maybe not fun, but would have an interesting position, a strong case to argue. I mean, knowing the facts as we know them today, there's an opportunity here for you all to make a difference in a small way, but in a small move that'll have a big impact in many ways in moving the case forward. I am not saying, Senator, just so we're clear, that the treasurer is not doing her fiduciary responsibility.
Okay. With this bill, you have given the presentation about millions that might have been lost along the way. This bill specifically talks about divesting from ExxonMobil and any company that extracts coal. Have you looked at Vermont's investments to determine whether or not what kind of an impact there would be if we actually divested from ExxonMobil and any company that extracts coal?
Well, not specifically, but I would say that your coal holdings, I understand, are really quite small. And there may be one or two holdings to make that change would be more illustrative of what you all are thinking about. Would it have a big impact one way or another on the portfolio? It would not. In the case of ExxonMobil, the cost of selling your shares in ExxonMobil, that's such a marketable security that there's no big incremental cost for that, in my opinion.
Do you know how much we have invested in ExxonMobil?
I do not.
Thank you.
Just curious, you're still part of Trillium Asset Management?
Yes, I am the vice chair of Trillium Asset Management and joined them last June 30th.
Just out of curiosity, the two funds that you make, could you explain to us how much money you make off of them?
The two funds that what?
The two funds that you have that are fossil fuel exempt or don't have any fossil fuels in them?
We have one fund that we manage that is called Portfolio 21. We call it the Global Equity Fund. The fees that we charge are just moving to 99 basis points. It's about $400 million fund. It's been fossil fuel free. since its inception 16 years ago, and it has outperformed its benchmarks after all fees. How much money we make at 99 basis points on 400, that would be probably $4 million in fees.
And you said that your company is very social responsible. If the winds change in the political picture, and we feel that child labor is a huge issue worldwide, how many of your holdings would you then drop because we don't want to do anything with child labor, or whatever the next win that we have as a legislature?
Well, as I've tried to explain it, and my apologies for not getting the point across, the child labor is something we have argued for and won and gotten companies to change. We are very active going on proxies with companies. We currently have, last year we were on 30 proxies trying to get companies to make a change on child labor and other activities that would fall under the environmental, social, and governance. I think we can have an impact on that by engaging. I'm saying that in terms of the fossil fuel companies, it's impossible to engage with them because you're talking about the only thing they do, and they have been so adamant on this particular question for a long time. Now, on the political side, it wouldn't surprise me, sir, if, as we know after who's going to be the Democratic and the Republican nominee, that we finally have a discussion about climate change in both parties, not just one. And I think whoever steps into that position is going to have to deal with this. I was part of the Paris talks, and I gave a number of talks on how are we going to finance this conversion to non-carbon global economies. Remember that more than 80% of the energy we consume globally is fossil fuel based. And in order for us to reverse the trend, to mitigate what's going on, we're going to have over 80% be renewables. That's the path we're on. That's the path we're going to have to be on. And trillions, literally trillions of dollars are going to have to be raised for that. I would love to see an oil company step up and say, we really have to change and go down this path. I haven't seen a major fossil fuel company do that yet.
In your non-fossil fuel, does that include gas, heating fuel, coal, propane, diesel, and wood?
I'm sorry, I don't
In
understand.
your non-fossil fuel investments?
Does that include? Well,
gasoline.
Gas is a fossil fuel.
Oil is a fossil fuel.
Oil is a fossil fuel.
Coal.
Coal.
Propane.
Propane comes from clean gas.
Natural gas.
Yes.
Diesel.
Yes.
Wood.
No.
Second largest carbon put out in this country.
From wood that's burned, yeah. No, it's not one that we, first of all, there's not...
Carbon footprint is a carbon footprint.
I understand that, sir, but there aren't public companies that are really in the wood business. I know we burn wood in lots of different places. And right here in Burlington, for example, we have our own wood plant. But that's a non-issue from an investment point of view. It's a very big issue, as you rightly point out, from a carbon point of view. And there are other sources of greenhouse gases that we haven't talked about either. But the bulk of them come from coal, oil, and gas. That is the core of fossil fuels. It's much bigger than wood. The three of those together.
I respectfully disagree because Wikipedia says wood is number 2.
In terms of greenhouse gas emissions, globally or in the U.S.?
In the U.S.
Yeah. Well, we could bet lunch on that.
Thank you.
Thank you. Yes, sir. Sorry.
Oh, I'm sorry.
First, I just want to clear up one thing. When it comes to tobacco, there was legislation moving through the State House, but before that passed, our treasurer decided to divest from tobacco on its own. Excuse me. And also, to be clear, the original bill that we were debating in committee called for divesting from the top 200 carbon producing companies over 5 years. I'm wondering, how did California go about their divestment with that legislation? legislative and the governor, how was that decision?
Yeah, well, they had, the treasurer became actively involved, and a portion of the governor is very pro-environment. And they are taking little steps, but they're moving in a total direction. So they're not there yet. They have a long way to go. But divesting coal is their big first step, and their coal holdings are bigger than Vermont's and more complicated, actually.
Well, was that decision made then by the treasurer and the governor, meaning not legislatively?
It was not legislative, no.
I presume that in your work at Trillium, you manage funds for others.
Yes.
And they go to you because of your willingness to invest in fossil fuel-free funds.
Correct.
And similar to the question that I asked Bill McKibben before, I'm just wondering whether people regret making those investments. In other words, this idea that we're going to risk and that we're at risk and we're going to lose money if we invest in fossil fuel-free funds. I'm wondering what your experience is with that.
That is a really good question. When I first started doing this in the 80s, if you recall, oil was high, as it is today. Not today it's low, of course, but it was over $100. And the initial solar and wind companies were not at all profitable, and nobody really made much money in it. For example, when I started Winslow, the cost to produce a watt of electricity through solar was $100. Today, it's under $1. So yes, you had to be totally committed, and one of the reasons I named the company Winslow, because it's two words, wind, slow. And that led, and if you weren't willing to take that level of volatility, which we had to take in those days, but no longer, you had to be patient. But I've never had somebody say they regretted being in the space, particularly as it's become increasingly profitable and significant.
So is it fair to say, because I've heard people say, and I'm not an expert on this stuff, that fossil fuel-free funds have been able to outperform standard S&P funds?
Yes, they certainly have over recent time periods. In the last 1, 3, and 5 years, if you had avoided all the fossil fuels, which represents about 7% of the S&P 500, that category has declined twice that, or it's underperformed. It's only performed half as well, if you will, as the rest of the overall market. So if you've been in fossil fuels, you've lost a lot of money, and I would predict you're going to lose a lot more.
And you would say coal is a good investment?
Terrible investment. I've made 2 investments in coal in my life. They were both clean coal companies. They both went out of business for various reasons I won't get into, but there is no such thing as clean coal, and I don't think there ever can be.
Ron, did you just clarify something? When we get back to the bill that's actually in front of us.
Yes.
Senator Polino was talking about a wide expanse of investments. And we are literally looking at 2 things in the bill.
Yes.
One is what you have testified as a very, very small holding in coal extraction entities.
Correct.
The second one is ExxonMobil. We wonder how ExxonMobil.
How has it done? Again, it would be the time period, but the whole industry has not performed as well as the analysis. If it ESG and you're looking hard at the E, I don't see how Exxon could be in any portfolio.
Good afternoon, Mr. Robinson. I'm not sure. I have a question about customers we may be working with. I don't know if you have any institutional investors that would be comparable to pension funds, such as the state's pension fund.
We deal primarily with Ely Mazzaneri's non-municipal state. We deal with a lot of religious organizations and a lot of educational institutions. Not really, to my knowledge, we don't have a municipal fund. And by the way, I'm not here soliciting the business.
Well, and so the reason I ask is because one of the impediments to moving forward is the prudent investor rule.
Yes.
And so I think I'm trying to understand how for groups that have made the move into ESG investments, they found a way to feel so they're meeting their fiduciary responsibility, and they've also been able to embrace other goals for that fund without being charged by someone, a pension beneficiary or other, that they are failing to be a fiduciary responsibility.
Right. Now,
So,
do you want me to comment on your comment, or do you?
well, that's, I mean, I think that's the
Well,
what
you're-
we need to solve.
You put your finger on something that's really important, because when I first started doing this, I would talk with trustees on fiduciaries, and they would say, we can't restrict these holdings in any way. That makes no sense. The last group meeting I had on this with 3 lawyers in Boston, not Boston lawyers, but around the country, was the whole concept of fiduciary responsibility on this particular subject has gone from, no, that is our fiduciary responsibility is not to do that, to your fiduciary responsibility is what's in the very best interest of your organization or the people you represent. And I'm here because, one, I believe, I like Vermonters, I love the state, and I think that they deserve not to be into a category that frankly is going to disappear. The whole group's going to disappear, that's where it's going. And part of it's going to be ugly, as it is for the coal companies today, but it's slow death.